Over the course of the last 10 days or so, there were several runs on several different banks within the United States borders and beyond the United States borders. You have banks like Silvergate that went under. You have banks like SVB, Silicon Valley Bank, that went under. You have Signature Bank that's going under. And then you have Credit Suisse, which was bailed out, which is not a U.S. bank. Besides for these banks, there are about another dozen banks that mini bank runs started to happen. These are mostly regional banks that needed shoring, that needed help. Of course, these banks, they don't partake in cryptocurrency, so those banks are actually alive and the actual banks are being shored up and bailed out or pre-bailout. Some of those banks include banks like First Republic Bank. The way this is happening is the Federal Reserve, they have reserves, and they have approximately $2 trillion worth of reserves that they can shore up all various different banks. And these reserves started back in 2008 during the collapse of all of the banks, during nearly a collapse of our entire economic system. Currently, the Federal Reserve has injected $300 billion in the matter of a 24-hour period. In a moment, I'm going to go to my desk and show you a bunch of very interesting charts. By injecting money into the economy, the Federal Reserve now is not in a state of quantitative tightening. They're in a state of quantitative easing. When people say the Federal Reserve prints money, people don't actually know what the F they're talking about, and they don't actually print the money. There are various different methods that they could do. The several methodologies include being able to buy and sell bonds or bills. Bonds being long-term, bills being short-term, and notes, which is extremely short-term. If the Federal Reserve wants to inject money into the economy or do quantitative easing, they take their cash reserves, they buy up these bonds, and now these bonds become assets on their balance sheet. And as these bonds become assets on their balance sheet, they just injected the same amount of money by buying all these bonds. This is called quantitative easing, and the Fed's asset sheet goes up, which I'll show you in just a moment. The Federal Reserve can also do quantitative tightening, which is what they were doing for the last year or so to battle inflation. Quantitative tightening is the opposite. Quantitative tightening is when they either sell their assets or choose not to renew those assets. If you choose not to renew those assets, your balance sheet is going to go down. If you sell your assets, your balance sheet is going to go down. Over the last year, the Federal Reserve was literally between a rock and a hard place, and that rock and a hard place is just closing in on them. They're in a really bad situation right now. As you have all of these bank runs and bank collapses, the Federal Reserve is to blame by many. Will I blame them? I'm impartial. I just give you guys the data. A lot of people are saying that the Federal Reserve raising the interest rates as aggressive as ever in history, except for the 1980s, is to blame. All these banks have something called fractional reserve banking, which means they have to keep a certain percentage of the money deposited. For the most part, it's 12%. It does vary depending on the size of your bank and a few other things, but let's use the number 12%. That means that for every $1 million that somebody deposits, the bank only needs to have $120,000 on reserve. So if you come to the bank, you can get your $1 million. But if more than 12% of all the depositors, give or take, come and ask for money at once, the bank does not have the money. They physically don't have the money. If you ever went to a bank and you want a large amount, let's say $50K, the bank is not going to have that cash. They're going to have to order the cash to come in. Anybody that's ever tried to take out a large amount of money from the banks. Because of this fractional reserve banking, if enough people come to ask for their money, this is called a bank run, which means the bank cannot facilitate all the withdrawals. And that is what's happening when you have these collapses or near collapses of banks. A bank run can literally be triggered with anything. A lot of FUD is what triggers bank runs. FUD of some big investor saying that the bank is running out of money, a downgrade, a lack of investment perspectives, so on and so forth. When the bank run happens, they come at the bank. The bank has no funds, but the bank does have assets. And the bank needs to sell those assets in order to compensate the withdrawals, which then allows the bank to increase the threshold of not 12% to whatever percent they can, as long as they sell their assets. A lot of banks, to keep it safe, end up buying bonds from the Treasury. When they have those bonds, they're worth a certain percentage. Those bonds at the time of purchase, most of these bonds were purchased during the COVID era, have a very low interest-bearing rate, probably somewhere below 2%. When they go to sell the bonds today, bonds are worth significantly more. So when they have to sell their bonds to come up with assets, they're selling them on pennies on the dollar. How much pennies on the dollar? That all depends on the various different things that they're selling and the current rates. By doing this, the bank then gets into a deficit, and the bank has something that we call a hole, which means they owe more money than they have. And that's how a bank collapses. The Federal Reserve has this program that was initiated in 2008. As per JP Morgan Chase, the Federal Reserve has nearly $2 trillion in this program. I don't know how much they have. This is as per JP Morgan Chase, that they nearly have $2 trillion. $300 billion was already deployed into the market. That's approximately half of the money that was deployed back in 2008. Now, you could look at this as a glass half full or glass half empty. That is up to you guys how you want to analyze this. The Federal Reserve can now deposit more money into the economy. The Federal Reserve balance sheet is now where it was in November of 2021. So we literally backtracked about a year and a half with all the work that we've been doing. Recently, we got good numbers for CPI, and we got really good numbers for PPI. If unemployment happens to go up, expect the Federal Reserve to stop raising interest rates. As opposed to before, Federal Reserve would be raising by 25 basis points. Expect any news of unemployment going up. The Federal Reserve now can breathe and stop raising interest rates. The reason why they have to stop raising interest rates is, as they raise interest rates, if there's any more bank runs, the banks are not going to be able to sell their assets. The same thing that happened to SVB. As the interest rates go up, it's harder to borrow money because it all trickles down to smaller banks. It goes the Federal Reserve, it goes the biggest banks in the entire country, and then it goes to prime banks, extra large banks, medium, local banks, regional banks, so on and so forth, right? That's how it trickles down. And the higher the rate from up top, the federal funds rate, the higher the rates are all the way down, which means your credit card bills are higher, your car payments are higher, your school loans are higher, so on and so forth, etc. and etc. Because this is happening, venture capitalists or investors, including yourself, you invest in stocks, right? But on a large scale, right? A grander scale, are not as easygoing with their funds because their funds cost more money, which means they don't have as much, which means they can't just invest all willy-nilly into any company, which means they have to be extremely vigilant with their cash. Because they're extremely vigilant with their cash, a lot of startups or pre-profitable companies are having a really hard time. As the rates keep going up, these hard times keep expanding. As these hard times expand, these companies need liquidity, which means they need their freaking money. They go to the bank, I need my money, and this is how the cycle starts and ends. Now that we got that part finished, right now we have an all-time high for credit card bills, and we have an all-time low for percentage that people are saving from their bank accounts. Back during Volcker era, this is the last time, like 1980s, that we had high inflation, they raised the interest a shit ton, a lot higher than we are now. It was like high double digits. The issue is when they had high double digits, their debt to GDP was sub 100%, which means for every dollar that was brought in, they can cover their debt. So if they're making $1, the US government is making $1, they owe less than $1. Our debt to GDP is around 120, 125%, which means for every dollar the United States is making right now, we owe $1.20 or $1.25. We are literally bankrupt every single day. We cannot pay our loans. The higher we raise our interest rates, the higher our debt to GDP becomes. Because as a government, as I said, we need to borrow money. We need to pay money. This is the way capitalism works. And as we're raising these interest rates, unlike what happened back in the 80s, every time we raise them, we are bankrupting ourselves just a little bit more. And this is literally a game of cat and mouse. As we're raising interest rates, credit card bills go up. American populace are at an all-time high of credit card bills. US government is at an all-time high of credit card bills or their debt to GDP ratio. And you see where I'm going here. As interest rates are going up, credit card bills are already at an all-time high and people are saving all-time low. What do you think is going to happen? Pop! Economy. We kind of got ourselves a little bit of a lifeline. In my personal opinion, I could be completely wrong, that I believe that we will have a bull run right now. The bull run, I don't know how long it's going to last, but it just makes sense because all of a sudden we're putting money in the economy. If the jobs, right, unemployment goes up, and you have these PPI, CPI reports, PCE reports coming in at neutral or as expected, or cooler like the PPI, this is going to open up the door for the Federal Reserve not to need to raise interest rates. And this is going to increase the entire stock market. And this is going to increase the entire crypto market. This is also going to increase the real estate market. As they're raising interest rates, that means that in theory, not a direct correlation, the federal funds rate does not correlate mortgage rates. Mortgage rates are based on a 10-year yield. But in theory, this was raising the mortgage rates. As the Federal Reserve is no longer going to raise interest rates, this should cool off the mortgage rates to a point. Now, I do go in detail between real estate and the 10-year treasury on my real estate channel, but I won't go into depth on this channel right here. I'm going to go over to my desk. I want to show you guys some charts. I'm going to keep trying to add these economy type videos. Some people are telling me that these are the best videos that they see on my channel, but for some reason they never do good. I might just start a brand new YouTube channel and it's literally going to be finance news. Let me know, guys, if you want me to make a YouTube channel only for finance news, where I talk about only microeconomics, macroeconomics, and world events. No stocks, no crypto, no real estate, not specific, right? Just how it's affected by the micro and macro of the economics. Let me know if you guys want that channel. Let's go over to my desk right now. And if you do want to support this channel for all the freaking hard work that I do, I would appreciate it. There's a channel membership down below. It's $3 a month. You get access to my Discord, which is free already. Link is down below as well. You get a really cool logo next to your name, and you get really cool emojis that only you could use. Also, you get access to my public stock portfolio and my public crypto portfolio. Go over to my desk right now, and let's get it hot in here. This is the Fred. Fred is an extremely powerful tool. Fred is run by the St. Louis Federal Reserve Board, and they essentially keep track of data, track of our economy. It's absolutely amazing. This is total assets, less eliminations from consolidation. And this literally just came out 2 days ago. I would love to see the next chart. This is what happened during COVID right here. During COVID, 4 trillion. This is the asset, right? This is the Fed's asset, which means this is their balance sheet. And this is for every dollar that this goes up, that's an extra dollar inside the US economy. This is COVID. We went from 4 trillion to 7 trillion. And then it just kept going up, up, up. We went from 7 trillion to right around $9 trillion. And then all of a sudden we got what we called quantitative tapering, which means we're tapering down. How did the Fed do this? They didn't sell, they just stopped buying. So when something expires, they didn't buy. And when it expires, it's off your balance sheet as well. All of a sudden, it went down, down, down. But all of a sudden, right here, guys, look, we went from 8.3 trillion. We went all the way up to 8.6 trillion, $300 billion in a single day. Well, where did this money come from? And if you see, this is exactly where we were on November 2021, approximately. So we literally backtracked 1.5 years. This is a report. The Federal Reserve lent $300 billion in emergency funds to banks in the past week. So cash short banks have borrowed about $300 billion from the Federal Reserve in the past week. As I said, how does the Federal Reserve do this? They buy bonds from reserve banks. By buying the bonds, they take it on their asset sheets, balance sheets. By buying the bonds, they buy the assets, they put it on their balance sheets, and they take funds and give it to the bank. Now, this is not physical cash. This is all done through electronic payments. Nearly half of the money, $143 billion, went to holding companies for two major banks that failed over the past week, Silicon Valley Bank and Signature Bank. Triggering widespread alarm in the financial markets, the Fed did not identify the banks that received the other half of the funding or say how many of them did so. So, half of the money came to support all of the depositors and holders in Silicon Valley Bank and Signature. The other half was for other banks undisclosed. So you see where I'm going here? Interesting. It's not just these banks. These are just the banks that are getting the praise. And it's not just the banks going out of business, getting bank runs. There's a lot of ones that can survive if they have some help. Both holding companies for the two failed banks were set up by the FDIC or Federal Deposit Insurance Corporation, which has taken over both banks. The figures provide a glimpse of the scale of the Fed's assistance to the financial sector after the two banks collapsed this weekend. The first glimpse. So there's definitely going to be more. The rest of the money was borrowed by banks seeking to raise cash, likely at least in part to pay off depositors who tried to withdraw their money. Many mega banks, such as Bank of America, have reported receiving inflows of funds from smaller banks since the bank failure last weekend. Bank of America, Citibank, and JP Morgan, probably Wells Fargo, are the biggest banks right now. And I'll show you why in just a moment. And while all these little regional banks are getting hurt, these banks are making a shit ton of money because people are running to safety. It's funny, you shit on these big banks as local businessmen. The woke people don't want to use big banks because they're bad, evil. But when shit happens, woke goes to sleep, and you're going to use any bank as a run to safety. An additional $153 billion in borrowing from the Fed over the past week came through a long-standing program called the discount window. It amounted to a record level for that program. Banks can borrow from the discount window for up to 90 days, typically in a given week. Only about $4 to $5 billion is borrowed through this program. The Fed has lent an additional $11.9 billion from a new lending facility and announced Sunday. The new program enables banks to raise cash and pay any depositors who withdraw the money. Michael Feroli, an economist at JP Morgan Chase, said in a research note that the Fed's assistance is so far about half that it was during the financial crisis 15 years ago. This is a chart for consumer debt. This is consumer loans, credit cards, and other revolving plans, all commercial banks. This is what we're doing in the last year, just going straight up, straight up, straight up, straight up. 5 years, you see, goes down and boom, skyrocketing. This is the money that we owe as a population. This is a report from JP Morgan Chase. They're saying that the BTFP could be around $2 trillion. What is the BTFP? A bank term funding program. The bank term funding program was created to support American businesses and households by making additional funds available to eligible depository institutions to help assure banks have the ability to meet the need for all their depositors. Also, First Republic Bank, they had an influx of nearly $30 billion. Jamie Dimon, JP Morgan Chase, Citibank, Wells Fargo, and Bank of America all deposited $5 billion each to First Republic Bank. That's the first $20 billion. After them, USB Bank, Truist Bank, PNC, State Street, Bank of New York Mellon, each deposited another $1 billion. Goldman Sachs and Morgan Stanley deposited $2.5 billion. The big banks are depositing it to show strength of the smaller banks. So they're depositing their own money into these smaller banks. Terms, conditions, nobody knows this, but they're trying to assure the American public and the world that our United States banking system is gonna not fail. Is not gonna fail. It's too big to fail, even if you're a smaller bank. And I think they're doing the right thing. At the end of the day, they're not saving banks in terms of the government, but they are saving depositors. And we need this. They're trying to stop a massive bank run. They're trying to stop this at Silvergate, Silicon Valley Bank, and Signature. They don't want this to go any further. They're trying to contain this shitstorm that we have right in front of us. And by doing this, there's not going to be a bank run on every bank. Eventually, it can actually hit our largest banks. And then the US government really needs to step in and say, hey, we're going to bail out the banks because these 4 banks are too big to fail. And Goldman Sachs, Wells Fargo as well. Also, this became a dick measuring match. Who's going to invest how much? Oh, we got 5 billion. Well, we got 1 billion. And then Goldman Sachs comes in last at the end and they're like, we'll do 2.5 billion. So the more money you have to deposit into these smaller banks to shore up the smaller banks, as a big bank, you're showing your strength as a big bank. Like, yeah, we're strong. We got the money. We could do this. This is an economic update of what's happening. Because of everything that I said right now, I ended up buying something called the TQQQ, and I bought calls on TQQQ. TQQQ is a 3x leverage on the NASDAQ. I believe that all of this is going to increase the stock market. I could be right. I could be wrong. So far, I am right. I also closed out my short positions. My short positions on NVIDIA, my short position on real estate, my short position on the NASDAQ, and my short position on the SPY. I am looking very closely to short NVIDIA in the future. NVIDIA keeps going to 52-week highs. It's going through the freaking stratosphere. And people have this notion that the renaissance of NVIDIA, and I used to hold a shit ton of NVIDIA. The renaissance of NVIDIA is AIs. NVIDIA is going to power all this AI revolution. And I just don't buy it. NVIDIA is trading at a ridiculously rich PE. I think that NVIDIA is overvalued, especially what's happening right now. I think that this whole revolution of computers and stuff is going to slow down because the economy freaking sucks. I could be right, I could be wrong. But my plan is to short NVIDIA in the future. Not right now. I think it's going to keep running up with the rest of the market, in theory. And I'll see. The best thing about making plays is you don't have to go through with the play. If something changes, then your play does not play out, right? No harm, no foul. But you have to have a plan with what's happening in the economy. You have to have a plan for what's happening with your money. And hopefully, cryptocurrency starts acting the way that it should, because it was literally created during the 2008 collapse, the bank runs, right? Like, that's why Bitcoin was freaking created. So hopefully that happens. And in terms of real estate, I am looking for real estate. I'm actually going to be in Florida in the middle of April. I don't know if any of my fans, if you want to call it that, who is into real estate or construction, is around the Sarasota, Naples type area. That's not where I'm going, but I'm going close to it. Let me know. And yeah, I want to tell you guys one last thing before we go any further. And this is the most important part of the entire video. I'm going to need you to keep it clean in between because hygiene is very important. Until the next one.